What's the big story about the Moody'S report? The ongoing stress in African economies will hurt the country's banks via their links with their governments in 2021, says Moody'S Investor Services in a new report published today. The rating agency says its 2021 outlook for African banks remain negative. For Nigeria, the report says oil price drop will continue to take its toll on the local banks into the new year, while highlighting non-performing loans in other jurisdictions. Joining me to discuss this is Joshua Odebisi, the Banking Research and Analyst at Vetiva Capital Management. At very short notice, thank you so much, Joshua, for coming through into this conversation. How does this report resonate with you in terms of its outlook on Nigerian banks?
Thanks for having me, Boasen. I think with all these international reports, it's quite obvious that they're quite bearish on our economy. And I think this Moody's report does not deviate from that. I find the report to be a little bit too bearish, simply due to the fact that, we're in a much better situation than we were in during the 2015-2016 crisis, where NPLs shot up to about 15.1%. Currently, we're at about 6.4%. And we're not even seeing the same kind of lows in the oil market as we saw back then. And also, I don't think the report takes into account the fact that the number of loans to the oil and gas sector have sort of evolved, not just reduced, but also due to the fact that a lot of them were restructured and taken away from foreign currency loans, which a lot of them were, which caused a lot of provisions at a point. Most of them have been restructured towards local currency loans, and so this has also helped to sort of reduce the need to provide quite so heavily, as well as improved repayments. And that has really helped the banking sector a lot. You can see that in the last 2 years, NPLs have been fairly decent. Currently, NPLs as at H1 were about 6.4%. But I think to say that the oil price drop will continue to have an effect or pressure the banks, I'm not entirely sure. We saw in Q1, Q2, and Q3 some restructurings happening in the banking space, about 40% of their loans. Now, I think even if those restructurings only push the moratorium out for a year, by the time they come due, by let's say H1, end of H1 next year, we might start to see a little bit more activity, as we already know that the COVID-19 vaccine has begun being administered in some parts of the West, and this could definitely translate into some of our biggest buyers. So you have your China, you have your India. By this time next year, we will probably be seeing more stable oil prices, maybe not completely recovered, but definitely around these levels and nothing lower than the current $45 per barrel levels we're seeing. And all of these will help to support stable income for the banks. And even if interest income does not grow, the fact that interest expense due to the current yield environment has remained quite low, I think it's quite evident that they'll still make some good margins from their interest business. And I think the bank also, Moody's also went into some detail about reliance on the government. And I think that that's a little bit misguided, simply due to the fact that, outside of a small chunk of the bank's overall income that comes from fixed income securities, there's also the fact that, they're able to mitigate some of this with foreign currency revaluation gains, which we saw a lot of this year, and that actually helped to bump up quite a number of banks' income. We saw FCMB reporting over $4 billion just from foreign currency revaluation gains, and other banks like your GT, your Access, even FBNH got in on that, even though they have some legacy issues when it comes to foreign currency. And so outside of maybe one or two banks who still have a few legacy issues with regard to loans to the oil and gas sector, I don't think that that's going to have as much of an impact as Moody's says it will on the banks in 2021.
Where are the pressure points really for the local banks, Joshua, in terms of why is oil price very critical in terms of analyzing Nigeria's, whether it is the fiscal position or the position of the banks for these rating agencies and other as well?
Well, unfortunately, it's simply due to the fact that we're very reliant on oil exports for a lot of our foreign currency income, and so this will definitely flow into the rest of the economy. Now, what we saw previously was a lot of companies borrowing from the banks in dollars, and then when the oil price crash happened, they, made significant losses and had to provide a significant chunk to offset those losses and the fall in oil prices. Now, like I mentioned before, that has changed quite a bit, and we've seen a lot of those loans being converted to Naira, and this will also help to offset some of that pressure. Now, as for other pressure points, definitely government policy is, I think, the biggest pressure point and the biggest risk factor, because we are not sure what the CBN will do going forward to try and, stem the flow of the outflow of foreign currency. And that is really where the uncertainty might come in, because of the fact that the CBN is doing its very best to try and hold on to, this exchange rate, even though they've had to devalue twice, officially, and maybe you could say 3 times with a soft devaluation recently. But the banks have caught on to this, and they know that this kind of pressure will only continue to build. And so a lot of them have net open positions that are a bit long. And every time the CBN is forced to devalue, these banks make, revaluation gains, which adds a lot to their income statements. So I think overall, it's not as simple as saying, if oil prices continue to go down, then the banks will lose, because chances are if oil prices go down, then that means that Nigeria's foreign currency gains will be lower, which means that the banks who have gone long will probably see another devaluation or two, which will increase their positions and, add to their profits. So that's just the way everything works together.
But we've seen the local banks recently, like Fidelity and others, like Nova Merchant Bank, going for commercial papers, including investment banks. What does it really mean for the local banks? Why are they borrowing out there at this point in time? Why the rush?
They're just taking advantage of the situation that the CBN has created, because borrowing is so cheap for them. They know that government is borrowing on the short end at less than 1%, is 0% levels. So they know that if they come in for commercial papers between 6, 7, 8, 9%, they know that they'll get a lot of takers. That's cheap money for them that they can then invest into loans and make significant profits in the medium term. And so that's really what they're doing. They're taking advantage of the opportunities that the CBN has created.
On the final one, you touched on this a bit earlier. We're talking about the closeness of banks to the government. Is it in what area is that in terms of government securities that banks are holding, the size of that at the moment?
Well, so in the Moody'S report, they sort of try to insinuate the fact that, because of how much banks are holding in terms of government securities or government debt, that if anything were to happen, that the government, that these banks would be at risk. But I don't see it as that cut and dry, simply due to the fact that, these are all, again, local currency debts. And so overall, it's very, very unlikely, and it would take, a pretty big disaster for the government to start to default on these debts. So I think they're in a safe position. Maybe they might not be able to make as much in terms of coupons on a biannual basis. However, they can still make some trading gains. And the truth is that the CBN and the government will not be able to continue to keep rates this low for that long. So eventually, yields will go back up.
Okay, yields will go back up. Thank you so much, Joshua Odebisi, banking analyst at Vetiva Capital Management.